Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and a look ahead. And without further ado, after a great show last week, and we've had actually a little bit of activity here that Miles is going to describe, starting with gold.
Yeah, gold did a fair bit of movement over the last week, all to amount to about nothing as we ended. Looks like we're going to be ending this today, Wednesday, at about 1735. But we did have a nice little 1670 drop down in there in the midst of all this back on the 5th this week. So we have seen some volatility take place in the gold market. Again, we're staying within this channel. This is going to be the third time now, down around 1670 with a pop up to 1760. I guess, back in the beginning of May. So we're building this little sideways trend. It will be good to find out if gold is going to put in a third consecutive high following the high back in the beginning of April around 1740, then the 1760, 1765 I just mentioned. Next one would put us up in the 1775, 1780 range if we build this rising channel, or we could turn right here, 1735, 1740, put in a little head and shoulders pattern and maybe see a little bit of downwards resistance. So over the next week or two, looking forward to see if gold holds the channel or not, or steps up to that next price level.
The one thing I would expect to continue is the volatility. Those numbers you just talked about, that represents a 4% swing in the price.
In a few days.
Yeah, in less than a week. And you talked a little bit about last week seeing a little bit of a lower low in this recent action. Today's pop certainly helps. A lot of it came from just going from 1715 to around 1742 here on Wednesday as we record. But I think that all markets are going to see a tick up in volatility, and not just to the bullish upside like we're talking about in equities here in a bit, but in general, things are going to try to settle out and feel their way around, see what the quarterly numbers come in looking like in a couple weeks. So get ready for some continued volatility.
Well, 1670 is a pretty healthy reversal. If you look at where this last move started, now I'm not talking about where the down move ended at the end of March, but if you look at the first V reversal back up, then you have this turn back down kind of end of March, beginning of April, and that sets the new bull market floor at 1560. So if you take 1560 all the way up to 1765, lo and behold, your 50% correction line is 1670. So right where we ended up hitting 1, 2, 3 times now, third time this week. So we have had a pretty healthy reversal. I always like 618s just because I think it sounds good. It's nice to hit that little Fibonacci number. But a 50% retracement is completely viable. 3 attempts into it. If we get a third push higher, that to me signals bullish strength. Now, if we get a lower reversal, let's say we stop here and start moving back down, I would expect us to see lower pricing.
You and Robert talked last week about the expectation due to seasonal weakness or seasonal biases or trends for there to be that expectation. We'll see. But keep in mind, gold's up 14% year to date from where we started the year to where we are now, and that's despite all the volatility. It's up 18% from that low around March 23rd or so. And so you're real strong numbers there, but when compared to silver, far more volatility in silver here just from that March low that we put in and where we are today.
Yeah, I appreciate the soft toss over to silver because you've got all these kind of conflicting long-term, medium-term, short-term channels that are getting built here. Like in the long term, we've had this long-term compression building for a year and a half now, which looks like we may be seeing the end of, kind of pinpointing out at around 1750, and we've been pretty hard stuck, minus that March drop, pretty hard stuck in between those two for quite a while. In the medium term, just going back to last fall, we've had this downwards kind of flat channel, or at least not compressing channel down, which again, we've broken above. And in the short term, just over the last couple weeks, we're building a nice channel up. So we've got all these drawn on the chart. So what that tells me is you've really got one price we need to break above, and that's about 1850. And you've got a couple prices below that that can provide support. So I think you've got a lot stronger story expecting silver, or at least a lot stronger momentum pushing silver upwards right now after the reversal from the March fall.
Yeah, since that reversal, it's represented an over 50% gain, and yet silver's flat year to date. So we talk about gold's 14% climb. Well, that's why that ratio's gone from the mid-80s to now here we're sitting at 95 to 1 today. You guys talked about it breaking below 100 last week. We're already at 95. So that silver upward channel that we've now formed in the short term has certainly narrowed the gold-silver ratio, and that's really good. That's something that we hope will proceed or progress into the lower double digits. But keep in mind, too, the equities markets have increased almost 50% since their March lows. They just continue to march. So silver has acted just like the equities markets, believe it or not, and yet the equities markets are flat year to date. So both silver and the stock market, and arguably even platinum, are getting back to their starting point on the year.
Platinum continues its step up to compression. Robert and I did talk about this last week also. We did actually have some downwards movement. If we look at the platinum chart last week, this third compression cycle actually did have a flat to increasing floor. Now we have a decreasing floor. So we haven't broken above or below the compression quite yet, but I would expect to see that over the next couple weeks. Again, with platinum, I kind of feel like you have a 3 drives up and then a decent drop back down, maybe to the 720 to 750 range, worst case scenario. But again, when you're in these channels, you're just speculating as to which direction you might end up going without zooming out and taking a bigger look. And ultimately, you take the big look in platinum, and we know platinum is due for a resurgence up. So regardless of these price moves, $50 up or down, I know 50 can sound like a lot, but when platinum's 2,400 again, you're really not going to care.
Speaking of 2,400, you might see that again in palladium. That last week's chart was really powerful, and I don't think anything's happened since you showed that big wedge either.
No, just tightening that gap.
Yeah. Is that going to the upside, back up to 2,400, or are we finally going to see that roll over?
Well, I mean, it's the same question, right?
Yep.
Like if I were short-term trading platinum here, I'd be doing nothing with one finger hovering over the buy button and one over the sell button, just kind of waiting, because that's a pretty flat compression sideways right at that 2,000 mark. People love double-digit zeros. So triple-digit zeros are real enticing. There's no real technical reason why 2000 is any more important than 1986 or any other number. It's just psychologically, a lot of zeros really gets people attention. So I think that's why we've been hovering around this 2000 mark. So no words on palladium right now as far as up or down. It doesn't matter because I certainly wouldn't be buying it. My money would still be going to platinum because in this room, we care about the ratios, not about the US dollar price.
Yeah, I did see on the news Ford's getting ready to ramp back up production. I think all the automotive manufacturers are really looking to do the same thing in this post-COVID recovery. Whether or not they ramp up, like Ford's projecting, at the pace that they were at prior to the COVID pandemic onset, but we'll see if it's able to pick up. And if it does, that might put a little wind in the sails of palladium and allow it to break out above that. I just don't think it's a safe bet for the long term. I wouldn't be sitting long palladium for years to come. I see that platinum price you talked about, 2,400, likely being hit ultimately in the next few years and being an excellent ratio trade for us.
Well, and let's say palladium goes nowhere. Let's say it just sits at 2,000 and platinum goes to those old highs. You don't need palladium to go down to pick up an excellent ratio move.
That's right.
Platinum at 2,400, which is the old high. Palladium sitting exactly where it is today. You just tripled your ounce exposure.
That's right. Yep.
So it doesn't have to go conflicting directions. You just need one to move a little faster than the other. Same with silver and gold. So finally, I'm glad you brought up the Dow. So we'll hit these last couple charts here, and then we do have a couple other things to say just about what's going on geopolitically right now and affecting these economic markets. The Dow, following its 38% drop earlier this year, is now 6.5%, or at least got to 6.5% away from those highs. So congratulations to all of you out there investing in the equity market. We have managed to push it back up. I know none of my paycheck has gone that direction, so I don't know where that money's coming from. It ain't from me, but it's pretty revealing to see now, as of this week, a openly stated recession, as well as I've heard arguments, numbers as high as 30%, 40 million Americans out of work. Somehow the equity market is finding some solvency and finding some investment money from where?
Yeah, money printing, capital injection, sovereign nations, central banks, government budgets, all of the above.
Yeah, I really hate using the word manipulation just because it's like bringing up Hitler in an argument. Where do you go from there?
Yeah, let's just say it's not a free market. All right. The free market has money on the sidelines. right now. You make a joke about people sitting at home investing in the stock market. No, that's just really not what's happening. Yeah, there is some of that, but not enough to set the fangs at all-time highs. The NASDAQ is through the roof right now, and yet the economic recovery hasn't even really gotten legs. We'll hear from the FOMC again, the green shoots in the economy. Things start to turn around. You had a huge jobs number boost where 2.5 million jobs that had been lost in the previous 8 weeks were regained, right? That's good. It means maybe we bottomed in the unemployment numbers, but that doesn't mean that you just added 2.5 million jobs because the economy is robust. So where's the money coming from? I'm sorry, but that is where it's coming from. And manipulating the equities markets is different than manipulating the mindset of the investor. And that's really the intention, is manipulate the mindset of the investor. FOMO. Let's make sure that everybody has a fear of missing out on investing and catching this wave of this V correction. I'm not buying it personally. It's going to be a W correction. That's fine. It's healthier. Expect a pullback here in the coming weeks or few months. And there's going to be other great opportunity to make some short-term trading money in the equities markets.
Well, and that dead cat bounced real hard back in 2008 following the real estate issues and then the credit crisis issues. The 2008 crash wasn't a single event. It was a two-stage event. Dow fell, right. Dow rebounded, Dow fell harder. I certainly don't. I know I'm being a little tongue-in-cheek about this. I certainly don't want to give the impression that it's a lighthearted joke by any means. We all deal with crisis different ways. I know, Tori, in your personal family, you're dealing with job loss. In my personal family, dealing with job loss. So the idea that people who are stuck sitting at home right now could possibly be online buying stocks, I hope you hear that for what I'm saying it as.
Oh, yeah, absolutely. And you bring up a really interesting point. Let's go back to 2008 to 11. These are three really powerful charts that you have put together here. Let's look at what the Dow did from that market bottom or that initial decline in late 2008 to what it did in 2011. This is what we expect to see happen. You will get economic recovery and you will have earnings that are pushing stock values. Right now, we've never seen a wider disparity between stock values or prices and the drastic reduction in the earnings. It's not earnings driven. Okay, well, back here, let's look at this chart of what the Dow did. Now look at what gold did compared to the Dow. Yeah, the Dow had a nice rally over the next 2.5 years. And that, again, is with manipulation. That's still quantitative easing 1, 2, and 3 following TARP that got us into that recovery.
Right.
They printed their way out of it. Well, gold priced in that currency printing. Well, so did silver. Now look at what silver did. The reason I want to bring these three charts in and you look at the multi-100% return on silver is because of the fact that we're set up exactly right now. Remember, at that time we were coming off a ratio of around 80 to 1. We're coming off a ratio of 125 to 1. What's silver going to do this time? It's just cheap gold. So let these three charts remind you of the most recent historical example we have from the financial crisis as to what to expect and how early we are in that recovery and how over the next couple of years you have tremendous opportunity, whether this dead cat bounce turns out to be a true V correction or whether it's a W correction. Doesn't matter. Over time, you're faced with great opportunity here based not only on earnings or the lack thereof, but on the injection of capital, on the result of the intervention. And that's what I'm telling you is the primary reason to be owning the metals right now.
Well, in terms of this injected Fed money, there was an FOMC meeting this week, Tori. I think you got some notes.
Yeah, they just actually released minutes from that meeting that wrapped up today. That's oftentimes why we record on Wednesday for release on Thursday, so we can try to capture those. And no surprise, the Federal Reserve decided to hold interest rates steady at near zero, right, where they've been. And it's basically saying it's intending to support a post-COVID economic recovery by keeping rates lower. That's still manipulation of the markets, right? You're manipulating interest rates, and thus you're manipulating recovery. And that's great. We need them to do that responsibly. But Jerome Powell actually said in the press conference, we're not thinking about raising rates. We're not even thinking about raising rates. So there's nothing on the horizon here that lends any indication that they would raise rates. That'd be catastrophic here. They need borrowing to ramp up. The velocity of money has dropped. We wonder why no inflation yet. In fact, the Federal Reserve came out and they actually expect inflation to remain low, just 1% in 2021, and then rising moderately to 1.5% the year after that. And their inflation target is actually 2%. So they're not going to be happy with low inflation numbers. They need that to reverse. But you have this opportunity here again, we talk about opportunity, to look at what money can do in such a low interest rate environment. If it's a credit-driven economy, then they need to get credit flowing again. So the money printing's ramped up, the number of dollars in circulation have skyrocketed, but the velocity of money has fallen through the floor. So they need those interest rates to be held here at 0 to a quarter point. And they say the economy is recovering. We'll see how quickly they can enable that to happen.
A number of weeks ago, we did a show where we were trying to answer the question, let's say, of why is the dollar going up while all this money printing is taking place? And lo and behold, as that started to slow, Robert pointed out a couple weeks ago, hey, look, the dollar is falling through the floor. So that's what you're starting to see, is we're just now starting to see what happens when you bring all that money to the table to try to prop up a system. But like you said, the velocity slows down, so you start to lose buyers on the other side of that. Well, here's the U.S. dollar index now just above 96.
Barely.
So the U.S. dollar has completely fallen off the table since about the end of May, and I think will continue to do so. Now, again, you're going to get bounces there from time to time because that's just how trading works, but it's pretty arguable that the longer-term trend, probably for the next 12, 18 months, maybe more, is going to be down in the value of our currency internationally. And that's going to continue to slow volume and velocity, and it's going to lessen and lessen the capability of these FOMC meetings to hold interest rates down and to keep pumping more money into the system because you have to have buyers on the back end. What's the end result of that? You and I pay more at the gas pump. You and I pay more at the grocery store. The price of gold goes up along with all other commodities. It's not going to be easy.
And you bring up a key point because you are seeing some deflation right now. It's very rare that you actually get deflation, and that's lower prices. And you are seeing that at the gas pump right now with the oil market dropping and what have you. But let's now throw up a fourth chart. We're going to be spontaneous here. We'll add a fourth chart here, and that's going to be the dollar index chart over that same period of time, that 2008 to 2011. And look how remarkable the decline is and how it corresponds to the silver price increase, gold price increase, and the Dow Jones Industrial increase. And that's going to be a very telling chart because I think you're right. I think that we're seeing the beginning of all four of these charts playing out identically.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, head on over to our website, McIlvaney.com. If you have any questions, you can always give us a call at 800-525-9556. You can find us on Twitter at ICA Gold or on Facebook at McIlvaney Financial.
Thanks for listening. Have a great week.